Money Radio for a really great future. We're talking real money.
A huge occasion, apparently, transpired last week. Passed us by. I don't think many of us even noticed that the important anniversary, at least according to so many folks in the financial media, that occurred last week. We're going to talk about that in a minute. Hi, everybody. I'm Don McDonald. This is the Talking Real Money show and podcast. I am Don. That is Tom. You are there. We're glad you're there. Tom is back from the, what was the name of that football team you went to see again?
It was a debacle with a capital D, so let's just leave it at that. What do you say?
What team was that again? That debacle all over
here's
the
good
field?
news.
Yeah.
I've already forgotten. I've moved on, so my life is better. Let's just leave it at that.
Did they clean up the debacle?
I think the whole stadium should be taken down like other things are in that same city, as you know, with the anyway. It's a pretty place. It's a very beautiful place, but the team, not so much.
Lovely. Not the game, but
not the game, not the team.
And I was very impressed with all those people in yellow. They were very excited about the game.
The traditional 60-40 ratio, with stocks to bonds.
The 60-40 split?
It did. The Steeler fans were 60 and the Raider fans, sadly, were 40. So it goes.
Our phone number here, if you'd like to call us and ask us some stuff, is 855-935-TALK. That's 855-935-8255. We talk about money, your money, and the things you do with your money. And what was the big event that happened last week? Well, the bull market, supposedly, the stock market's bull market turned 2.
Speaking of bull, yeah, okay, got it.
There wasn't one. It wasn't the stock market. I hate that the S&P 500 and the term stock market are synonymous.
It's easy. It's easy to remember. It's 500 of the biggest companies.
Just say S&P 500.
Right, but they don't because it's the stock market. So
right. They forget the internationals. And I did not
the small
realize,
cap and the value and emerging markets. Blah, blah, blah.
I did not even think about this, but I'm looking at this. We actually had a full-fledged bear market. I didn't even think about this in 2022.
Yeah, it's a bad year.
It hardly felt like it.
Well, but it actually did because stocks and bonds are both down. But you're not a guy looking at his money every day. A lot of other people are looking at their money every day like, oh, I have less money and grind your teeth. Okay,
so what does all this mean? The 2-year anniversary of the bull market, Tom. Given that you're an expert on bull.
Exactly. I got that covered.
Yeah.
What does it mean? But here's what I don't know what it means, but I can tell you what it raises because a lot of people talk to me about this. And that is, I'm scared. I'm scared because you've had 2 years of up stock markets. Then you layer in everything else to be scared of right now, whether that's the war in the Middle East, the war in Europe, the still somewhat high inflation, the risk of a possible recession, interest rates. You got this election coming up soon, a wall of worry that stands between us and rising stock prices. That's what has people worried. So, yeah, 2 years. But let's just stay with your 2 years for a minute because that's an interesting number. On average, and we have not researched. We have not talked about this. On average, how long does the average bull market run? I don't know, probably a long time. My guess it would be a long time. Yeah, more than 2. Yeah, so 2 years really would be relatively short if it went down, right? I mean, it could always go down. You should always be expecting it to go down. And you mentioned something else. How important has diversification been when it comes to this? If you're better diversified, my guess is you would have gotten longer bull markets, periods when you were making money. Now you've seen the ways, because if you think 2000 through 2009, that S&P 500 you mentioned a moment ago lost money, but international stocks made money, smaller companies made money, value stocks made money. So there you are. Wait a minute. You diversified and it actually bailed you out a bit. So rather than being focused in just one part of the market, that's more important than the 2-year anniversary, for sure. And you know what's funny? That the longest bear market since World War II was 2000 to 2002 for the S&P 500. Wow. That was the longest. It was 2.5 years. Almost 3 years. Was unpleasant. I remember that. And that you would have been bailed out in that by an international portfolio, which is why we continue to
harangue you about having a diverse portfolio. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Well, thanks to today's topic, which is the 2-year bull market for the S&P 500, two-year anniversary, I just discovered, and I never knew this before, that I was personally responsible for one of the bear markets back in the past. Summer of 1956, we had a bear market. Lasted for 15 months, and that was right when I was born.
Your birth signaled it.
My birth signaled a bear market.
the end of the good times.
I'm an indicator. I did not know that.
Oh, that's scary.
And so is it a big deal? Here's one of the reasons we're talking about the fact that the market has been doing well for 2 years is because over that 2-year period, over and over and over again, the news media reported the market has reached new highs. And that gets you thinking that, oh my gosh, we're at a new high. Should I get out and wait for a new low?
Or should I invest with money that I have? I mean, this is the other part, right? I've got this cash, or I came into some money. I'm going to wait. I'm going to wait for the election. I'm going to wait for interest rates.
Until the market goes down.
Because it's going to go down. You know it's at record highs. It's got to go down. And there's a couple things to think about when it comes to that. First of all, this is, I think, where the confusion lies. Because if you look at the market closely, really closely.
Oh.
And you shouldn't, first of all. But you already know this. About half of the days stocks go up and about half they go down. I think that gets people's brains kind of crazy because like, no. So they don't really understand the fact
now the key word in his sentence was days.
I know, but here's
single days.
Then go a little bit more months. It's about 75% of the months are up. So that means only 25% are down, which is about the same when it comes to years.
75%.
It's about 3 out of 4 years are up. And yet you want to get caught up in this, wait. Your asset allocation, as we've said on this program, I don't know, 1,000 times, is about you. It's not about the market. Your ratio between risky things like stocks versus bonds, cash, is about what you need, not about what the market has done. And you should always use past tense. That's the other thing. And here's the other one. And you love this one, Don. The market is always going to fluctuate, right?
Yeah.
Yeah. It's going to go up. It's going to go down.
That's the risk for which you get rewarded.
Bingo. And so you've really got to figure out how to set that aside. You've really got to figure out how to not pay close attention because nothing is permanent except change.
And I would like you all of you who think you can do this, because you go, it's obvious. I recognize the fact that this is all going to go to hell in a handbasket and I'm going to wait and buy in because I'll know when to buy and then I'll know when to sell. I want you to go back. You don't have to go very far back, but if you've been investing for more than 20 years, I want you to go back on your statements. Go pull them out of the drawer somewhere, go online and look back. And I want you to tell me that you completely liquidated your portfolio in the fall of 2007. You completely liquidated it, and you didn't get back in until, I'm going to give you a 3-month or 2-month period. You got back in January, February, I'll give you 3, March of 2009. If you did that, then
you're smart.
You are amazingly prescient.
Yeah.
And you would have bought stocks. You would have sold them and then bought them back 57% lower with the S&P 500.
That is a good timing move.
Did you do that? You don't lie.
No, I know. Yeah,
we lied, and we can't hear you. We can't hear you. Why are you lying to yourself?
But bigger point than that is even if you had just bought and held a diversified portfolio mix between stocks and bonds going back to 1956, since you're going to raise that year, you did just fine. Even sucking it up during the tough times, you didn't have to be in or out. You didn't have to do any of that stuff. You just bought and held. You would have made plenty of money.
But along the way, again, for the S&P 500 from 56 until today, you would have had a period where you lost 28%, 22%, 36%, 48%, 27%, 33%, 19%, 49%, then 57%, 33%, and 25%.
Now you're making me nervous. I mean, and again, this is another reason to own other things. Smaller companies, value companies, international companies, which haven't been as great, frankly, since the Great Recession that you mentioned in 2008. And this year, Don, how has a diversified portfolio done this year? Do you know? You never look at these numbers.
I never look. I don't like looking at the numbers because they do. I'm telling you, they do have, no matter how steeled you are, to not allow yourself to get emotionally riled by the market. It does have a psychological impact, no matter how strong you are, which is why every bit of investing has to become a disciplined process.
Yeah,
so what is the diverse portfolio
100%
do? Tell us.
100% globally diversified portfolio up 12.5% year to date. 100% S&P 500 up 23% year to date. And the DFIGX, which I like as a proxy for bonds because it's the intermediate term U.S. government bond fund, it's up about 2.5% year to date with a yield of a little over 2.5%.
Which means it broke even, basically.
Yeah. No. They're both up. 2.5 plus 2.5.
Oh, it's 2.5 plus. So the total return was 5.
Yeah, total return's about 5. So pretty good.
That's better.
Yeah,
that's a better.
So yeah, it's been a good year. Yeah, it's been a good couple of years, but there's just, in my mind, again, no reason to get worked up about the fact that it's been 2 years. Or, now you're right, the bigger headline always is new record high. I just looked at CNBC this morning, and that was the lead story. Almost back to new record high. So
the moral, though, really is ignore it all. You can't do anything in reaction to things that have already happened. It's too late, baby. Ooh. And you do not give up this delusion you live under. That you and we hear you call all the time. We know you're deluded, and yet you still insist that you're not because, well, I'm smarter than the market. No, you're not. Everybody's dumber than the market. Everybody.
They don't all sound like that,
smart.
By the way. There's only those two guys back in the Midwest somewhere that really sound like that that I remember.
Hill country.
So, Hill country. Okay.
Hill country.
Texas.
Well, that's because I think that's because I was, over the summer, I spent a little time.
Oh, you've been, well, come on, where haven't you been over the summer? You're a lot of places.
It was so funny. Debbie today said, we should go up and get the trailer and go out for a couple of weeks.
Are
really?
You out of your what?
Really? Seriously?
You remember that trip? Wasn't that long ago?
No, she goes, I really enjoyed it. Yeah. Right. It's amazing how your mind fogs over.
Oh, yeah. Blanks it out. Yeah, good.
Paints a much brighter picture. Our phone number is 855-935-TALK. That's 855-935-8255. The thing we talk about is the financial part of life. Now, that can be the spending part. That can be the saving part, and that can certainly be the investing part. And if you want to be lied to, we can suggest some other podcasts.
Oh, there's a lot of them.
There's a lot of them. But if you really want to be told the truth, even though, what's that adage about the truth hurting?
It could be painful. It could hurt.
Yeah. The truth hurts. But it also, what's the other adage? The truth will set you free.
Yeah, I don't know when it comes to your money if that's true.
Of course it will.
Okay,
because then you won't get caught up in these things like,
I see.
And by the way,
it might set you to sadness too, by the way.
By the way, again, this is another one that we don't remember very well, but back in 2020, do you know how long the bear market in 2020 was?
It was very short, very steep down, and then turned around and went right back up.
33 days long.
There you go, yeah.
That was it. Hard to play a 33-day bear. 855-935-TALK. Give us a call.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And by the way, we talk about these terms, bull and bear market.
Oh, good point.
A lot of people go, bull and bear market. What does that mean?
What is that?
Yeah. What is a bear market? How is a bear market defined by the financial community, Tom?
I think it's a 20% decline from the previous high, I believe.
That is correct. Okay. That is correct. And then the bull market is rising stocks after a bear market.
20% above the previous low.
20, right.
Yeah.
So it's just terminology. It's weird terminology. There's a history to it, and I'm not getting into the history of it, but because you don't want a history lesson. although you might. 855-935-TALK is our phone number. You can call us with your questions, and we will discuss them live, like person to person. You can make a person-to-person call.
Haven't done
Remember
that in a
those
while.
days?
Oh, yeah.
Yeah, I'd like to make this person-to-person. You know that will be $23 a minute.
Yeah. Oh.
They were really expensive, too.
Glad we're not doing that anymore either. Yeah.
Yeah, now it's like...
No, your phone just costs $200 a month.
We don't even talk on the phone anymore.
Well, that just costs $200 a month, so it should call free. So
you can also, though, send in questions to us that we answer on the Friday podcast if you speak them, and we answer on other shows and podcasts when you type them. And that's done through talkingrealmoney.com on the contact form. And Tom just happens to have one of those in his
got a lot of
grubby little hands.
Got a lot.
Well, you got
now
one for now.
And you just mentioned something that's important, the disinformation campaign that's out there every day, and bad podcasts that give you horrible advice. Well, Andrew from Frederick, Colorado writes in, recently I've been reading the book and listening to the podcast Rich Dad, Poor Dad by Robert Kiyosaki, and it started to pique my interest in real estate and stock trading. I heard you talk about the book a long time ago. I'm curious if you've read it, what your thoughts are about it.
The title's really bad. It should be Rich Guy, Poor Readers.
Readers? Yeah.
Yeah. Rich Guy, Poor Readers, because there have been all kinds of looks back at Robert Kiyosaki's prowess and doing the things that he does, and it turns out the bulk of his money's made selling you advice.
Which is not unusual in this industry, by the way.
Which is a very lucrative thing to do. Sell you advice.
No. What do we think of the book? Now, I did read the book. I actually interviewed him on television. We had him on the older version of the podcast.
I was going to say, we haven't had him on this version.
No, we've never had him on this version.
And I wouldn't, because I think his information is not just horrible, it's dangerous.
I think it's irresponsible in some ways.
Yeah.
Correct. He recommends right now, I believe, because these headlines come through on my news feed. Of course, he's pushing gold. Of course, he's pushing, I think, silver as well. Maybe crypto, although I can't, but he always is in some headline somewhere. But his bigger picture opinion was, you need to be entrepreneurial. You need to be investing in real estate, flipping things, getting involved in that, borrowing money to go buy stuff. And he may still have all these classes where you go learn how to do this. And we've seen this many times over the years. And as you said, it often doesn't turn out so well for the people that do it. It's always great for the people selling it because they sell you the advice and then they walk away. So no, I'm not a fan of his work. I'm not a fan of the podcast either.
U.S. News actually looked at his predictions in April of 2011. He said the market was going to crash.
I don't remember that crash.
Didn't crash. Then in 2015, he said, quote, I've been predicting since 2002 that we would see a stock market crash in 2016.
Oh, okay. 14-year prediction. That's a long time to wait.
We did not really see that. There was no crash. Yes, there was a pullback, but by the end of 16, the S&P 500 gained 9.5%.
Not a crash. No,
for the year. Not a crash. 2017.
Gets better.
Another sign that a real estate crash is coming.
Oh.
My house has gone straight up since 2017.
Basically.
Straight up. Will it go down someday? Maybe. 2018. Unfortunately, we had a big crash in 2000. It was 33 days. Oh, no, 2000. 2000, that was 2010. Right. Yes. Yeah. We had a big crash in 2000, and then 2008 we had a crash. The next is going to be the biggest of all.
All time. This
was in 2018.
Oh.
6 years later. And he's been suggesting the whole time that you should be buying gold, not investing in stocks.
Yeah.
The S&P has been up since then over 120%.
Doesn't sound like a crash.
Wrong again. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Couple last things on Mr. Kiyosaki. I think people pay attention to him because he's got a well-known name, because it can't be based on substance. What did you say the bull market in the S&P 500 had done so far this year, 2024?
Almost 24% up. Up almost 24% year to date.
Correct. That's what I thought you said. Yeah. Robert Kiyosaki tweeted at the end of 2023, get some cash out of banks as you need cash. This may be the start of the biggest crash in history. That was 2023, December.
Yeah, well, okay, but you still got another 2.5 months this year.
Well, wait.
Crash.
He decided to stop predicting in May of 2024.
Oh,
instead,
so no more predictions.
No, instead, he decided to just make up his own reality.
Completely.
Totally made up his own reality. He said in a tweet, bad news, crash has begun.
Oh. I guess I'm going to run for the basement.
Apparently, there's a show on Apple TV about alternative universes. I think that must be it. We must live in a different universe.
I see. We're in a different
than Robert
place
Kiyosaki.
Okay.
So
kidding aside,
in his universe, the crash has begun.
I got one final story before we go, because I mentioned,
yes.
I know, I interviewed him on television.
Yes.
He was coming to Seattle. He had a newspaper ad. You remember this that said your financial future guaranteed. That was the ad. I took it into the interview and said, can you guarantee? Oh, no, I didn't do that. Somebody else in our organization, blah, blah, blah. I mean, took no responsibility whatsoever for promoting the fact that he said that to people.
He didn't write it. He didn't care. He
nothing to do with it,
money.
apparently. Anyway, so take that for what it is.
855-935-TALK. Call us, like Ed in Ohio just did. Hi, Ed. Welcome to the show.
Hey, guys. Nice to chat with you. I have a friend of mine whose husband passed away a short time ago. She is 57. He was 58. And she inherited a Roth 401k. And I'm trying to help her figure out what her options are moving forward as far as either making withdrawals, rolling it over into her account, or possibly into a Roth IRA, if that would be possible. And I've been doing some reading, and I've gotten myself confused because I seem to see conflicting reports.
Well, she can certainly roll that into an inherited. It's like an inherited Roth IRA.
No, she could roll it into her own Roth IRA.
Into her own,
spousal. It doesn't have to be inherited. It can just be into hers.
Because the thing about Roths is they're not subject to the. Well, and as the spouse, she wouldn't even be subject to that anyway. It would be just other people. So there's really nothing. It's just her. Now it's her Roth 401k, and it can be her Roth IRA, which is probably the better way to go, because there's really no big benefit to keeping it in the Roth 401k. She'll probably get better investment options. Probably.
That's true. Other than protections you get under ERISA, you might not get in an IRA. So maybe something there.
I think those are risks. I think people put way too much stock in those.
We're not lawyers. We're not going to argue with that. But I guess the question to you is sort of, what is your question?
What can she do with it?
Well,
go ahead.
Would she be able to start withdrawing money now? Does she have to wait until a certain age? And is there limits on the withdrawal as far as when she has to start or when it would need to be finished?
There's no time limit as to when it needs to be all taken out. You can take that one off the table. Now you do raise a good question, because she's 57, as to whether or not she needs to wait until 59 and a half, or see, this is where maybe I'd have to go look that up, because
there's the 5-year rule on Roths.
Yeah, that's a separate thing. But I'm talking about just the age at which you can start withdrawing money from a retirement savings account without any other ramification, remembering that the Roth is going to come out tax-free anyway. So I'm not sure about the getting started under the full 59.5 rule. Don, did you find it? Don's trying to find it now, because
you're supposed to keep talking.
It is a little confusing when you get to all that. But generally, a spousal inheritance, the best option, especially if the spouse is younger. 59.5. Okay, so it is 59.5. So she would face some sort of penalty on money that she's never going to pay tax on. So, yeah, I guess I would move it into her own Roth IRA and build the right portfolio, and then wait a couple of years
and
start taking it out.
Find other assets for the next year or so, year and a half, or 2.5, I should say, because he was 58. And find other assets and then start taking it out at 59.5. Thanks so much. We appreciate it. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
And we love taking your calls here on Talking Real Money at 855-935-8255. And let's go to Marysville now. Brad, welcome to Talking Real Money.
First, thank you. 1 year ago, I called you, and I had a bunch of money in a money market, and I had a chance to go with an investment lady, and I put $100,000 in Russell. And to date, I am returning 24%.
We are geniuses. You knew that, though, Brad, right?
Isn't that something?
We're so smart. I mean,
I couldn't believe it.
Okay, take it all out and then call us in 2 weeks and we'll tell you what to do then. No kidding.
Okay. Do you know people can't see your face, so stop that.
Okay.
All right, go ahead.
I'm kidding. That's a joke. Sorry.
No, I just can't. I can't thank you enough. And then, so I put I put a fifth into that and 4/5 into a fund in January of 24, which is a 60/40 fund. And to date, it's doing about 7.5%. And should I put more in the more aggressive fund?
Oh, that's a good one.
I don't really need the money. I'm not living off the earnings or anything like that. It's strictly an investment fund at this time.
All right. I have an important question.
To live on, etc.
Here's the important question for you. You ready? You sure?
Yeah.
You sure? Are you 100% certain that you will stay invested when your portfolio drops 30 to 60% in value?
I was going to say the Russell, too. That could be steeper decline.
Let's say 40 to 80% in value.
Probably more likely. You look at 08. Sure.
Are you okay with that?
Yeah, I'm not going to. No.
That's the problem.
There we go. We finally figured it out.
10 years. It would take 10 years to recover, probably. I mean, I experienced that in real estate from 2007 to 2017. It took 10 years to recover my real estate values. So
that's why we are absolute fiends about diversification. We know that Tom and I both know that we could, on our own money, very likely make a lot more money in just a small cap value portfolio with 100% of our money there, and we live and breathe this. We know it for a fact. And yet, Tom, do you have 100% of your money in small cap value?
I do not.
No. In fact, we both have a bunch of our money in bonds.
Which is, having heard you now, Brad, I think the 60-40 makes a ton of sense for you. Yep. I like the fact you have a little sprinkled in something that's, because generally that 60 is going to be U.S. large cap. Now you got a little exposure to some other asset class. That's fine. And I wouldn't mess with it. Nope.
I wouldn't either.
Okay.
We're in total agreement.
Isn't that funny? Because that's exactly what my financial advisor, what she told me. But I wanted to check it out. You guys are right on.
Yeah, and that's why earlier I was saying, when I watch the numbers, you get a little greedy. You go, well, maybe I should add a little more to my small cap value position. It's doing so well right now, and I don't, because I keep the discipline and I keep rebalancing, and I add regularly if I have money coming in. As long as I have a job, I'm going to just keep adding to my investments and keep doing it over and over again, and that has been a recipe for success for 100 years.
I like the word you use there, Don, greed, because we have a tendency to look and say, I'll just give me more of that, forgetting that there's another side to that mountain that will be very painful, as Brad just said. I had to wait 10 years to get the real estate market back to where it needed to be. That's a long time to wait.
By the way, that was in large part a hallmark of the fact that leverage increases the pain.
Good point.
And real estate is a highly leveraged investment for most people. So it looks really good on the upside. It just looks terrible on the down. Thank you so much for the call. We truly appreciate you being there and the nice comments. And our number is 855-935-TALK. And Frank, it's your turn.
Frank?
Hello.
Hey, Frank. You are.
Be as frank as you like. Go ahead.
Oh, gee, another bad joke.
Fabulous. That's my nom de plume.
Oh, okay. Sure, Bob. No problem.
You're going to guess what his real name is?
I was just going to keep trying. See what happens.
What's up, whatever your name is?
I was chatting with an associate recently about outperforming the market and his desire to outperform the market. And I have a couple of general questions and a couple of more specific questions for you Appella folks. One is the S&P 500 the quote-unquote the market?
In some people's mind.
If you believe that 500 stocks are the market out of about 13,000 publicly traded companies around the world, then sure.
See, Wall Street likes saying that, and the press likes saying that because it's easier for them to track the S&P 500 than to track the total market. Finding an index that accurately tracks and regularly updates the total global stock market is a little bit more work. And so they go the lazy route. Hey, S&P 500 is better than the Dow.
Yeah.
But I'd still rather people quote the total global stock market.
Yeah. So the answer, all kidding aside, frankly, no.
Okay, but kind of on an industry basis, it's a little incorrect, but that's what's done.
That's correct. It's just standard practice, but it's better. Again, it's better than the old standard practice, which for decades had been the Dow Jones 30 Industrials. At least now, more people are referring to the market as the S&P 500, and maybe someday before we're dead, we'll get our wish, and it's the total market, total global market.
Right.
And now,
don't die fast. Okay, so
yeah. And now to your more specific question about timing the market.
Okay, so I'm going to paraphrase, and you will, of course, correct me, that the Appella philosophy is that one can slightly outperform the market, however you would define it, by overweighting certain types of stocks, be they small cap or what have you. Again, you can fill in the details. And if I'm understanding that correctly, about how much more might be squeezed out, it's going to vary from year to year, but about how much more can be squeezed out by slightly overweighting certain sectors or types of stocks.
Before I let Tom get a little more specific, I want to make something really, really clear. When a firm, and we did this with Vestry, we do it with Appella, our expectation based on decades of really robust data from a lot of Nobel Prize winners is that by taking the additional risk.
Thank you.
By taking the additional risk of small company and value stocks and emerging markets and the like, that you should, over a long enough period of time, based on the past, or you should have in the past, and basically did over long periods of time, outperform slightly. What the exact number is, I'll leave that to Tom.
Well, okay, let's give you a couple of numbers. First of all, you mentioned small cap value. Small cap value over 98 and a half years now, right? We're coming up on the 100.
We're almost on the 100.
Has outperformed large cap in the U.S. by almost about 4% a year. Not every year, so you can't count it. Number two.
That's if you're 100%. 100%.
Correct. That's right.
Yeah.
So, but when you look at all of that data, Don just mentioned a few other asset class, international, emerging markets, more diversified. It's been somewhere around 2% more per year, but I would not count on that.
No.
Here's diversification really should be to protect you more than it is to make more money. That's the important part.
Yeah, and hang on with us for just a second because we can quantify it. What has happened a little better doesn't mean it will in the future. Don't go away.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
All right. The premise is, should an investor expect to be able to outperform the market?
I hate that term, by the way.
Yeah, beat the market slightly, make a little bit more money with a portfolio that has a slight tilt to small cap or value stocks.
U.S. and international, by the way.
U.S.
both.
and international, absolutely, both of those. And the answer is we would expect that. We certainly can't guarantee it. And the numbers, if we look back over, let's pick a period, let's say 30 years.
Yeah, I mean, it's hard to go back further than about 50 when you throw the international.
Right, no, I'm just going to go back 30 because that's a pretty standard retirement age
if you're
for
lucky.
people.
Yeah, sure.
If you go back 30 years and you just look at the S&P 500 compared to that global diversified index, you wouldn't have overperformed.
No, because the S&P has been dominant. There had a 10-year underperformance,
Right.
but then really other than that, it's been better. Yeah.
But if you go back that 50 years, which takes us, what does that take us back to 74?
Yeah. Ugly year there in the market. Yeah.
Oh, I should have known that because I just had my high school reunion for that period. And if you go back there, then the difference over 50 years is about 1.5% per year.
For the global
overweight value, overweight small
Here's the
cap.
reason I trust it. And that's a great question, Frank. We could debate this.
Yeah,
Here's the reason I
question.
trust it is because intuitively it makes sense. You're taking more risk. You're buying companies that are smaller. They're out of favor, all those kind of things. So you would think that people would pay more for the capital you put in that would have to make you more. Doesn't always happen. But it kind of makes sense from an economic standpoint. I'll put it that way.
And even the Nobel Prize winners will tell you the last 20 years have been driven primarily by a handful.
Amazing.
I mean, 10 stocks.
Scary.
Really.
Yeah.
And you'd have to think, again, logically, we don't know it for a fact, but you have to think logically. For example, the international market has had 20 years of underperformance.
Yeah. Long time.
The small
By the way,
cap
that
market had 20 years of underperformance.
makes me think, guess what's coming next? You moved your money out. Just you wait for it to go.
It makes me think that eventually that we're going to revert to the mean in those global markets. So we expect more, but we never promise more. Can't ever promise anything.
Well, nobody knows nothing about Monday, come Monday, or beyond. Does that help, Frank?
Yeah, that was a great answer. Very informative and great to keep the perspective on that it's more about stability overall in the portfolio.
Good way to put it.
Just try to squeeze out another percent or two.
It's a combination. We would of course love to have the performance we've seen over the last 50, but we just don't know that it's going to happen again. No. We don't know it. However, what we do know about a massively diversified portfolio of stocks even, is that it smooths out the performance over time.
It should be less risk.
It
should be. Because you just own more things.
Well, and you own more things in more places that don't perform. They don't. While markets tend to move a lot more closely than they did because of technology, they still don't move in lockstep. Exactly.
I think that's well put. Yeah.
We have run out of hour. We want to thank you for being a part of it.
Before we go, I mean, the question anybody should ask themselves is, why do you want to outperform the market anyway? Take market-like returns. They've been pretty good.
And we'll be back soon.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?